be talking to you about volume analysis. Now, volume is basically cherry on top when it comes to strength and momentum. Strength and momentum, they show you that whether the move is strong or not, but volume confirms the strength and momentum. So these three things go hand in hand, and this is exactly why it is important for you to understand what exactly is volume analysis and how it works. So all you have to do, if you're new to TradingView, all you have to do is go to search indicators, click on volume, click on the indicators tab, search for volume and click on that. Then you will notice that there is a graph kind of thing that has appeared at the bottom of your chart, and this is exactly what is volume. Now, volume is what tells us the number of transactions or the number of coins or the number of instruments that are being exchanged over a particular period of time. So right now in Ethereum, I am looking at the 1 hour time frame. That means one candle represents 1 hour of price movement, and then the volume below is what represents the number of Ethereum that were exchanged over that particular 1 hour. So if you look at this on Wednesday 10th of April, 5:30 p.m. Indian Standard Time, 60,000 Ethereum were exchanged, or 60,000 Ethereum were transacted throughout this entire 1 hour. Now, this 60,000 Ethereum, what does this tell us? This does not tell us how many were bought or how many were sold. This gives us a total number of Ethereum that was exchanged. Now, what we have to do is use this volume data, because the volume data alone is useless. It only tells you the number of transactions that had happened. It doesn't tell you whether it was buyers or sellers. What is going to tell you whether it was buyers or sellers were the candlesticks. Now, the candlesticks strength and momentum is going to tell you whether it is the buying that is happening or the selling that is happening. So starting from the very basics, what have we learned? First of all, to read a candlestick, we are going to use the imbalance of power. Imbalance of power shows us that there are sellers. The candle is extremely bearish. There is a slight wick on the bottom which shows that there is not a lot of strength, but there is some momentum. So this tells me that majority of the transactions that were happened on this particular candle were sellers, because that is confirmed by the price action. That is confirmed by the candlestick strength and momentum, and the volume is what tells us the number of Ethereum that were exchanged. Now, what exactly is volume and why do we even need it? Let's try to understand. So guys, including you and me, we are the small fishes of this market. The market is a very big ocean, and there are whales and sharks swimming to eat small fishes like us. And if you want to be on the winning side, you have to trade with the winners, because in this market there are only one winners, there's only one winning team, and that is the big fishes. The big fishes always and always win, and if you want to be a winner, you have to trade where the big fishes are trading. And big fishes is equal to big volumes, and the big volumes basically tell us that this is the direction where the big fishes and the big players are playing. And this is why we need to understand in depth why and where they are trading, and in which direction, whether they are buying or whether they're selling. And that's exactly why volume analysis becomes extremely critical, because it tells us that we are on the winning side or not. Because if you are playing against the bigger fishes, you are never going to win in this market, because they always have more money to play with than you can imagine. So let's try to understand how this entire thing works. So volume analysis, once again, we are going to read it and we are going to understand how this works. So let's see. Let's try to analyze this particular trend that has come down. So this price has came down from here to here, right? Now let's try to look at the volumes. The volumes, what do the volumes suggest? The volumes are going up. What does this mean? This means that the price is going down and the volume is going up, which basically means that the big players are interested in pricing Ethereum lower, in driving the prices lower. That's exactly why when Ethereum is going down, the volumes are going up, which means that the big fishes are interested in taking the prices lower. Let's take another example. So here you see the prices are going up. What is happening to the volumes? The volumes are also going up. This basically means the big fishes are interested in taking the prices higher. Now, this is basically another confirmation for you to understand whether you are on the winning side or you are on the losing side. So let's try to read more prices. Let's go on to daily time frame. Daily time frame is the perfect example for us to understand what exactly is happening over here. So now let's read the volumes. So if you look at this, guys, take a look at this move from here to here. What has happened to the volumes? The volumes have gone up, which basically means that the big fishes in this area are interested to drive the price of Ethereum higher. Now let's take another example. So here the prices started moving down. what happened to the volumes? The volumes also started moving down, which basically indicates that the big players are not interested in taking the prices lower. This might be just a temporary downside move, but in the long term, it also shows that the big fishes are interested in taking the prices much higher. And that's exactly what happened later on. The prices went up non-stop, and look at what happened to the volumes. The volumes started going up. Now currently what is happening? Currently the prices are going down. What is happening to the volumes? The volumes are also going down, which basically shows us that the big fishes are not interested in taking the prices lower, and eventually the price of Ethereum is going to go up. So this is extremely important, and this basically tells you that you are on the right side of the market. If you are already in an existing trade and the volume is in your favor, you should be relaxed because you are on the right side, and vice versa. But what is more important is for you to read before even taking the trade that whether you are on the right side of the market or not, because volume is basically an indicator to tell you that if you are on the right side of the market or not. So if you take gold, gold also has certain volume. Now this might in gold it might be a little complicated to read volumes, but you will get it with practice. So if you see over here, let me just delete all the drawings. What is happening in gold? The price was going up constantly. What was happening to the volumes? The volumes were pretty dry. Eventually what happened? The prices started dumping, and look at the volumes. The volumes started going up, and this basically means that the big fishes who are interested in taking the prices of gold lower in this particular area. I have come down to 15-minute time frame. As you go lower and lower, it gets a little bit more complex. So start with the daily time frame. When you come, if you want to practice volume analysis, start with the daily time frame and slowly move to the lower time frame. Once again, like I always say, if you don't practice these concepts, they are going to be giving you a very tough time and they're going to confuse you. So it is very important that you practice. You're getting all the filtered knowledge, but if you don't use it properly, it is not going to be worth it. So guys, extremely important is you implement these and you learn how to do it. This might be getting a little bit overwhelming for you in case you are just skipping through the lecture. Alright, this might be getting a little bit overwhelming for you in case you are just skipping through the lectures and not implementing and not practicing, and that's exactly why we need to take a little step back, take a little breather, and I'm going to show you how to put all the concepts together that I have taught you so far in order to take a certain trade. So let's get to the charts. Let's try to understand how to put all of this together. So let's say we are on the 1 hour time frame, okay? And we have to read a certain chart, we have to analyze a certain chart. The very first thing that I look at is the support and the resistance levels. So this is a support level which I understand it exists. This is a resistance level which I understand it exists. Then let's try to read the charts. So what I understand from this is, so you can also go down to the lower time frame to understand things. It might give you a better view of things. So if you look at this on the 15-minute time frame, I can see that there was a very weak strength and momentum on the downside, except for this particular candle and that candle only, because if you look at the other candle, this candle which is very huge, it has a very long wick which basically shows extreme demand, which basically shows a lot of buying pressure. Now if you look at the volumes are high, but the candle is bullish, which basically means there were a lot of buyers in this area. And then eventually what happened was the price continued to remain sideways and the volumes completely dried up, which once again tells me that the price is not interested in staying in this area. The price might want to go up higher. So what I would like to do is, maybe in this area I would like to wait for a confirmation, or I would like to wait for an entry. So let's say price comes back down here, makes a bullish candle and gives me an entry. I would like to buy in this zone, and I would like to wait for the price to go all the way above here and then sell my Ethereum. So this is how you put all the things together. So in very simple language, what I did exactly here is I used imbalance of power, I used the support and resistance, I looked at the strength and momentum, I looked at the volumes. Did I use any chart patterns here? Well, not really, because most of them are bullshit. But if you look at this very carefully, very carefully, this kind of looks like a double bottom, which is the only chart pattern that I have talked to you about in this particular course. Most of them are useless. Most of them you're never going to use it. All you need is support and resistance and the right understanding of strength, momentum, volume analysis and liquidity. Liquidity is a very advanced concept which we're going to talk about in the next few lectures. But let me give you some more examples. Let's go to Bitcoin, for example. So let me share with you guys one of my very recent trades that I took on Bitcoin. All right. So what happened was, and this is a trade that I also shared in my community. I also told everybody that the price is going to go up from here. So what happened eventually was, so if you look at this particular zone, so my analysis was very simple. This is a support zone from where there was a very violent up move. So naturally what you would expect is you would expect the price to come down and go up from here. So what we did, we expected the price to come down and go up from here. And then what happened? The price came down and formed a double bottom. The price started going up. Now if you look at the volumes, guys, what does the volume tell you? The volumes are coming down, which basically means the price is not interested in going down, and there's a support region. And if you look at the buy side volumes are increasing, the prices are going up, and the volume is also going up. So price came down, formed a double bottom here, and we were waiting for the price to go up, come back down here, and this is where we wanted to enter. So if you look at this, what exactly happened? The price came down, gave us a bullish confirmation candle, and this is exactly where I bought. I entered over here, and from there you can see what exactly happened. The price started going up and gave us a very nice profit. And if you look at what happened later, it stopped exactly at this particular resistance zone and came down, and I sold somewhere over here. So I exited this trade around 70,000 price of the Bitcoin, and this is where I got out. So this is all you need to frame the right trades. This is all you need to understand in terms of analysis. There's a whole different segment of risk management and liquidity that we're going to talk about, but this is the simplest form of analysis that you can ever do and that you can learn without beating your head and without complicating things for yourself. And then later on we got another similar opportunity. So if you look at what happened, I'll give you another example. So if you look at this particular zone, from here there was a violent upside move, right? So normally you would expect the price to come back down and respect that zone, and exactly what happened. And sometimes volume can scare you, guys. Don't get scared of volume, just shift to a different smaller time frame and it will give you a better picture. So if you look at this, there's a huge volume here, but look at the candle. There's a wick over here. So this doesn't necessarily mean that there was a lot of selling. So what happened? Price went up, high volume, and then the price went sideways, volumes dried up, price started coming down. There was a little bit scary volume, but it was only for one candle. So this one candle, you can ignore it sometimes, because sometimes something like this happens. Price came down, price formed a double bottom. You can see a significant rise in volume from here. Price came back up with good volumes, volume increased. Price when came down over here, you could have entered on this particular candle right here, which is giving you a very bullish signal right at the support zone which we drawn, and from there you can see the price continuously went up. So this is all you need, guys. This is all you need to understand how to frame the right trades, how to take the right trades and be on the winning side of the market. But this is not it. This is not what is going to make you profitable. This is just the concepts that you're going to use to analyze the charts. There's much more, and I'll see you very soon. In this lecture, I'm going to teach you risk management. Now, obviously, I've spoken about risk management in detail in Zero to Alpha 1.0. Obviously, you can go back and watch that in detail if you are not aware of how risk management works. But in this lecture, I really want to talk about some advanced risk management, which if you're part of my Discord community, you must be already aware of. So there's a difference in managing risk and there's a difference in just keeping a stop loss. Okay. So a lot of you guys think that, once again, if you're a complete beginner, you don't know what is a stop loss, you don't know how to manage your risk, go to Zero to Alpha 1.0. You have access to both the courses. Go to Zero to Alpha 1.0. I've explained risk management there in much detail. Very simple language. You should need to know what is a stop loss. You should need to know how to do position sizing. You should know what is a lot size, all of these things. Again, that is there in Zero to Alpha 1.0. Again, I don't want to repeat the same thing again and again. So, like I said, there's a difference in managing risk and there's a difference in just putting a stop loss, okay? And a lot of you, what you guys do is you just put a stop loss, okay? So what you think is that, my account size, if it's $100,000, I will just put 2%, and that means my risk is going to be $2,000 per trade. And if I lose, I should lose 2,000. If I win, it should probably mean that I should win more than 4,000, which is a 1:2 risk to reward ratio, right? And also, yes, you also need to know what is a risk to reward ratio. So That is not true. I'll tell you why, and I'm sure you will understand what I am about to say. Don't you think that 90% of the time when you are about to hit your stop loss in a trade, let's say you take a particular trade, it starts going against you and you're about to hit your stop loss, it's halfway there, don't you think that 90% of the time when that happens, the trade goes ahead and hits your stop loss? 90% of the time when you take a trade and the trade starts moving against you, you go ahead and take your stop loss. That is exactly what happens. Now that's exactly what happens in my system, which is you're gonna see in phase number 2, right? So what I like to do is I like to do active risk management. So there's just putting a stop loss and there's something called as active risk management, which I would urge you guys to do. So what I like to do is I like to cut my positions, and what I'm about to share with you is also going to help you a lot with building confidence with your system and building confidence with your risk management. So what I like to do is, let's say when I take a particular trade, so I trade on 5-minute time frame and 15-minute time frame, right? So I execute my trades mostly on 5-minute time frames. So let's say I put a trade, I placed a trade and I went short, for example. There's a 5-minute bullish candle against me. Now, most of you, what you will do is you will just watch that bullish candle. You know that there's a candle against you. You know that it's going to go and hit your freaking stop loss, and then you're going to be sad for the rest of the day. But still, you will not exit that trade. Why? Because you like to hold your winners. You like to hold your losers, right? Even when I want to say the wrong thing, I end up saying the right thing, right? That's how ingrained the right thing should be in your head. Again, that's not the point. The point is that you see that bullish candle against you, but you still watch it go and hit your stop loss. Imagine how much money you would save if you just decide that, you know what, if there's a candle against me, I'm going to cut my position over there. Now again, you might think that there's a chance that it might move against me and then go in my favor without hitting my stop loss. Again, beautiful, perfect. So in that scenario, what I like to do is I like to cut at least half of my position or 80% of my position, because as per my trading strategy, now again, this could be different for your strategy. This could be a different scenario for your trading system. Again, you will learn all of that in phase number 2 on how to build a trading strategy. But most of the time when this happens, the trade goes and hits your stop loss. So what you need to do is you need to actively manage your risk, and that's what I like to do. So whenever there's a candle against me, I cut 50% of my positions or 80% of my positions, because now most of the time when that happens with me, it just goes ahead and takes my stop loss. So this ensures that my actual risk is $2,000, but whenever I lose around $1,500, $1,700, sometimes $1,000, right? And if you're part of my Discord community, you know exactly how I do it, right? By the way, if you're not part of my Discord community, you're missing out on a lot, because I give my trade breakdowns over there where I teach things like this on an active basis, on a daily basis whenever I take a trade. So I would strongly urge you to join my Discord community. It's a one-time payment for a lifetime access. Again, it's a win-win situation. But again, once again, what I was saying is that you should involve active risk management into your trading, and that is going to save you a lot of money. And that also gives me a lot of confidence, because that I know that whenever I'm going to make money, it's going to be more than $4,000, and whenever I'm going to lose money, it's going to be less than $2,000. Not $2,000, less than $2,000, because whenever there's a bullish candle against me, let's say I go short, there's a candle that's against me, it closes against me, I like to cut down my positions. And I also like to aggressively trail my stop loss, because let's say if the price is, let's say again, I go short, and there's a lower high and lower low. If the price is doing that, I like to aggressively trail my stop loss, because if the price is coming back up and breaking structure on the upside, then it probably means it's going to go ahead and take my stop loss. Again, trading is a game of probabilities, and you need to play on the probability. So if a price is moving on the downtrend and it has broken structure and now it's going higher, it has broken the higher low, then it probably means there's a break of structure and the price is going to go ahead and take your stop loss. So why not just cut your position over there, right? And this is something that you need to involve in your trading as a trader, because this is going to save you a lot of money, and this is also going to give you a lot of confidence. Now, why do I like to exit half and not full when I know it's going to take my stop loss? Because again, there's a possibility that it might just go ahead and move in my favor, and I don't want to again regret that I exited half. I could have made a lot of money on that particular trade. So that's one reason. Another reason of exiting half positions and partial positions, once again, you need to realize the importance of this. When you exit partial positions, you are satisfying your urge of exiting. You are satisfying the urge of that particular fear that you're feeling, the feeling that you're feeling. You are addressing that feeling, but at the same time, by being in the position still with a smaller lot size, with a smaller position size, you are also facing that feeling, right? Because if I'm getting fear, let's say I take a trade and the trade is moving against me, right? I am feeling fearful because the price is moving against me. But when I exit half, I feel less fearful. I still feel fearful, but I feel less fearful enough where I can control myself, control my emotions, and still be in that particular trade if it goes in my favor, right? So that way I am facing that, Because if you don't learn to face these emotions and eventually become immune to these emotions, you will never become successful in trading. That's why you don't need to cut all the positions, because if you cut all the positions, you're basically running away from those emotions, right? You're running away from that position which could hit your potential stop loss. And that's exactly why, first of all, thumb rule is always risk 2% on every single trade. If you're a complete beginner, I would also advise risk 1% of your capital on every particular trade, and not more than that. But let's say you should always risk 2% on every particular trade, if not more, if not less, sorry. And always your goal, because see, we are traders. We don't make money for taking the right trades. We make money for managing the risk. We make money for losing less and winning more. How do you lose less? You lose less by cutting your losses when required. You cut your losses at the right time. You cut your losses when you feel there's a probability to hit your stop loss. That is what you make money for, because you lose less and you win more, right? You will get a lot more clarity on this on phase number 2 when I talk about building systems, and when you backtest those systems, you're going to get a lot of clarity on that. But your goal from now onwards as a trader is, if you have a $100,000 account, your goal is to never lose $2,000. Your goal should always be to lose less than $2,000, because that means you've cut your position before your actual stop loss. So I always make sure that me as a trader, I never hit my actual stop loss, because if the prices came 80% against me, there's a 90% probability that it will hit my stop loss anyway. So why not just cut it over there, right? So you need to get used to this feeling. Again, this is not the topic for this particular lecture, but I'm still going to speak about it anyway. When you have taken a particular trade, and let's say it goes in your favor, and now you're getting the urge to exit that particular position because you cannot see so much profit in your trading account. Exit 80%, exit half, because if you exit full, you are running away from that feeling of how, oh my God, I'm making so much money, right? So if you don't face that, you will never become a trader who's ready enough, who's prepared to take big profits. And that's exactly why you need to cut half positions, so that you satisfy your fear, address your fear, and at the same time, with the rest of the half position, you face that feeling eventually to become strong enough to face that feeling and trade with a big amount, with a big account size, and make big profits. So this is the difference between normal risk management and active risk management. So from now onwards, I want you to become a trader who manages their risk actively, and always make sure that you lose less than what your actual stop loss is. To be talking to you about multiple time frame analysis. Now, multiple time frame analysis is a small concept, very simple to understand, but also very important for you to read the charts properly. So now, initially we spoke about that there are different time frames, and every single candle of a particular time frame represents that amount of time. So if it is on the daily time frame, one candle represents 1 day of movement. If it's a 4-hour time frame, one candle represents 4 hours of price movement, and 1 hour, same thing. Now, it is extremely important, because a lot of people get confused what is the best time frame to trade. There is no best time frame to trade. This is like asking what is the best size of a t-shirt. There is no best size of a t-shirt. You just have to understand what suits you the best. And out of my 6 years of experience trading the global markets, I have come to a conclusion that these are the most important time frames that you will ever need. Weekly time frame is something that you need to look at the long-term trend and understand how the prices are going to move, how the prices are doing. Daily time frame is once again another good tool to understand that how the price is behaving in the medium to short-term range. So if you look at Bitcoin on the weekly time frame, it is in an extreme uptrend. Downtrend shows that the Bitcoin price is consolidating. The Bitcoin price is trying to find a bottom and then try to go up. This is what the daily time frame is saying. The 4-hour time frame, again, not very different from the daily time frame, but gives you a little more in-depth understanding of what is going on. So you can see here, I can see sort of a double top pattern. Price is coming down, hit retested, and then now I am expecting it to go up. Then the 1 hour time frame and the 15-minute time frame, and anything lower is really beneficial for you to understand what could be the best entry level for you. So 1 hour time frame is something which is going to be helping you out to maximize your entries. So maybe you can look at this zone. So you entered here, price went up, and so on. 15-minute time frame, again, depending different assets suit different time frames. So Bitcoin, I would not go anything below 15-minute on Bitcoin. Let's say I am trading gold. On gold, I wouldn't mind going down to the 15-minute time frame. 5-minute time frame is something that can be used for execution. So let's say you got a candle confirmation, you can go ahead and enter. So once again, but what is extremely important is for you to understand that every single time frame plays its own role, and every single time frame can be used in its own particular way. Every time frame has its strength and weaknesses. So for example, the weekly time frame can show you the higher time frame trend, but the weakness of the weekly time frame is that it cannot tell you where to enter exactly, right? And that is exactly why you need multiple time frame analysis. One very important tip when it comes to multiple time frame analysis that you need to follow is that always make sure that whatever trade you're taking, whatever confirmation that you need, at least 3 time frame should confirm that particular bias, should confirm that particular trade. I'll give you an example. So let's say I want to go long on Bitcoin, okay, and I am looking at a very nice zone. The zone looks something like this right here. So the zone looks good to me. I want to go long over here. So my trade bias is on the upside. I want to go long on Bitcoin. I want to buy Bitcoin. So let's understand whether the time frames is supporting me or not. So weekly time frame obviously supports me because weekly time frame the trend is up. The daily time frame also supports me because the price is bouncing back from the support region. It's looking good. The 4-hour time frame also supports me because here we can see higher highs and higher lows, prices going up, forming an uptrend. The 1-hour time frame might not support me because if you look at it, 1-hour time frame, the 1-hour time frame, what is happening? The price is in a slight downtrend, right? But did I get 3 confirmations? Yes, I absolutely did get 3 confirmations, and that is exactly what matters. Now, once again, if you're, let's say, a day trader, if you're trading on a very short time frame, then you might need these confirmations from a shorter time frame. This is an example of a swing trade. This is an example of a trade that I would hold for a few days, and that's why for me getting confirmations from the higher time frames was in fact more relevant compared to the smaller time frames. Now, what is eventually important is, do you have at least 3 time frames confirming your bias? And if the answer is yes, then that is a very good confirmation for you to go ahead and take your trade. And this is how exactly you use multiple time frame analysis to take your trades and understand the charts better. You understand this concept, and trust me guys, I have not spoken about this concept before anywhere else. So I want you to pay close attention, I want you to take notes, and I want you to take this seriously as possible, because if you understand this, you are going to be a master at reading charts and understanding how the price works. So guys, let's get to it and talk about liquidity. Now before we talk about liquidity, I wanted to explain you what is exactly liquidity and why is it so important. So I'm sure by now you understand that the entire market works on supply and demand. The entire market works because of buyers and sellers. If somebody is buying, that means somebody is selling. If somebody is selling, that means somebody is buying. And that's exactly how the market works. If, for example, let's say I want to sell my car for 1 crore rupees, or let's say if I want to sell my car for $300,000, but there is nobody who's willing to buy at $300,000. That basically means there is no liquidity. The market is not liquid. The market becomes illiquid, right? And that forces me to either lower my prices down or take my prices to a level where there is liquidity, where somebody is willing to buy. And that is exactly how the market works. Now, sometimes the market becomes illiquid, and that is exactly why it seeks liquidity. It wants to go to the area where there is liquidity, which helps the market do what it wants to do. And that is exactly why it is so important for you to understand this, because a lot of times the market is going to behave in a certain way where there is a lack of sellers or a lack of buyers, and because of that the market is forced to come to a certain level where there is sellers and there is buyers present, so that the prices can move smoothly and the market, big fishes, the whales, can do what they want to do. And that is exactly why it is so important for you to understand how liquidity works and why it matters. Let's get to the charts. Alright, so here we are at the charts. Let me give you an example of how exactly the liquidity works and why is it so important for you to understand. So now let's say there is an uptrend going on, there's a healthy uptrend going on, prices going up, everything's just going fine. Now there will be a point where the market wants to go higher, but it is struggling to go higher, right? So let me simplify this for you by making a line chart. So if you look at this, the market wants to go higher. Now, normally after this move, we should expect something like this, because there's a very good uptrend going on. But here you can see the market is struggling. The market struggled to make a new high, which basically means there's a lack of buying pressure, there's a lack of buyers. That means there is a lack of liquidity, right, from the buying side. The market wants to go up, but there's a lack of liquidity from the buying side, and that is exactly why the market is not able to go up. Now, if the market needs more buying pressure, it needs more buy side liquidity, what is it going to do? It will be forced to take the prices lower and collect more liquidity, come to a point where there are more people who are willing to buy, and then push the prices back up higher. So that is exactly what I gave you as an example from the car perspective. I gave you a car example, right? If I'm selling my car for $300,000 and nobody's willing to buy it at that particular level, that basically means I will be forced to sell it at a lower price where there is liquidity, unless I just want to hold it and not sell it at all. So the price is forced to come down violently to a certain level where there is enough liquidity. So now let's say this entire area, which also happens to be a support region, there's a pool of buyers. So this area is entirely filled with buyers who want to buy, who are waiting for the prices to come down and who want to buy. So the price comes down, collects the liquidity over here from this pool, and then decides to go higher. Because now the amount of buying pressure the price is going to generate and going to collect, it is going to make sure that obviously the price goes higher, because now it has a lot of buying pressure. So this is exactly how liquidity works. Same thing on the sell side. I'm going to give you an example for the sell side as well. Alright, so here we have a sell example, a beautiful sell example when it comes to gold, right? So let's see what is happening over here. So the price is trying to go up, but then the uptrend failed, the price came down. Now the price has been fighting. There has been a battle between the buyers and sellers. You can see over here. It might be looking extremely confusing to you, this entire movement. The price is trying to go up, trying to go down, whatever is happening. But now here we can clearly see, if you go and switch to the line chart, we can clearly see there is no buying strength at all. The buyers are genuinely struggling a lot. Even if you look at the strength and momentum of this entire price structure, you will see major moves are in favor of the downside. Major moves are in the favor of the downside. There's only one move that is in the favor of the upside, which is once again overpowered by the downside, right? So here you can clearly see that the price is struggling to go up, which basically means if the price is struggling to go up, there is no buying pressure. If there is no buying pressure, the price is struggling to go up. That also means that the price might go up, take all the liquidity, and then go down. There's also a possibility that the price might go down, take the buy side liquidity, and then go up. So now what we have to do is just to wait and watch. Wait for the price to give a sudden move, collect liquidity on the either side, right? So let me give you an example. So what do we have here? We have an extremely aggressive selling pressure from here, which basically means that obviously there is a lot of sellers waiting here. Then we've also got an extremely aggressive buying pressure from here, right? So we've got two support and resistance zones. So let's say we are somewhere at this level. Now we are confused that whether the price is going to go up or price is going to go down. So what we are going to do is we're going to wait for the price to do a violent move. We are going to wait for the price to maybe do something like this or do something like this, collect liquidity, and then give us a move. Because when the liquidity is collected, then it is helping us understand where exactly the move is going to happen. Now again, let me give you another example. So let's say you might be confused. Okay, so let's say if the price goes ahead and does an extremely violent move on the upside, something like this. If the price does something like this, then what am I supposed to do? I might be extremely confused. But before this upside move, did the price collect liquidity? I don't think so. And that is once again another good way to understand. So if you get confused, it's a very good way to understand that if the price is going to sustain at the higher level or not. Again, if you look at this particular move, the price went up and then suddenly came down. Why did it happen? Look at this. There was no buying pressure. The price did not collect liquidity. The price went up, did not sustain, did not collect any liquidity. Price came down, again back to the support. It collected liquidity now and then went up, right? So if there's a violent move happening without any significant pullback or without any significant correction, that probably is a trap, right? So now again, in this example, the price is constant, price suddenly goes up, takes all the stop losses, collects all the liquidity sitting here, collects all the sell side liquidity sitting here, starts going down. So guys, this is called a liquidity sweep. This is called, once again, you can give it hundreds of names, but this is called a liquidity sweep, where the price collects liquidity, decides to go in the opposite direction, because obviously it has been struggling to go in that particular direction. So this is a sell side example. Once again, don't get confused, but practice. The more you practice this, the more you will understand how exactly liquidity works and why it works, in fact. So once again, look at this. So here we've got a decent support zone, right? The price gave a violent move from here. The price came down, collected liquidity right here. You can see the violent move on the downside, collect liquidity, and then price is going up from here. So guys, if you just understand this, if you just practice this, and if you understand how liquidity works, and then you support and resistance, strength and momentum, volume analysis, and you combine all of this, this is going to give you such an amazing understanding about how the charts works, amazing understanding about the technicalities, and you know how the price works. If you understand this most important concept of liquidity, you are going to be a master reader of charts, and you're going to be understanding. Once again, let me give you another example, because normally liquidity is like fuel. Liquidity is fuel for the price. If it does not collect fuel, if it does not go to the, if a car does not go to the petrol station, it is not going to go far, very far, right? And that is exactly why we have corrections. That is exactly why corrections happen in the market. Again, Bitcoin prices was going up, came down, took the liquidity from the support zone, and then now it is going up. Always remember, whenever the price comes down to take liquidity, it will always take a liquidity at a strong support or a resistance zone, because obviously that is exactly where the liquidity is. That is exactly where the buyers and sellers are waiting, and that is exactly what you need to understand, because this is extremely important. And if you have understood this, this marks the end of phase number 1. I will see you in phase number 2. Welcome to phase number 2. If you have completed phase number 1 and you still don't understand the concepts that I've spoken about, make sure you watch all the lectures properly. Make sure you watch the 0 to alpha old version of the course properly, because what I'm going to tell you now is something that once again I have never spoken about anywhere else in the course before, right? So this is extremely important, and without this it is going to be extremely difficult for you to become an actually profitable trader. And this is a mistake, and this is something that people are not able to understand and people are not able to do, which is building your system. And you need to understand that anything that is working on a very large scale today, anything that is making a lot of money today, has been successful only because they have been working on a certain system. When you go to a McDonald's, you don't expect anything brand new. You expect the same red colors, you expect the same golden arches, you expect the same menu, you expect the same cost for the burgers, and you expect the same Happy Meal. And that is one of the reasons why McDonald's is one of the largest fast food chains in the world, because they have built a system. They have standardized the process, which leaves no room for error. The temperature at what their French fries is going to be fried at is also defined. There is a standard operating procedure that McDonald's has made, which is defined, which once again leaves no room for error for them, and that is exactly why it is profitable and it is running at such a large scale at every corner of the world. Without this, it would be impossible for McDonald's to scale up and become such a big business, because everywhere, every market, there are going to be things that are going to be a little challenging, a little bit different, but because the standard operating procedure exists, that is exactly why McDonald's is profitable and McDonald's is able to do what it is able to do, right? And same thing with trading. People get into trading and they think that they would become successful at random. They would become successful by just doing some random stuff, and that is absolutely incorrect. You cannot become successful without systemizing your processes and without making sure that everything that is happening with your trading is systematic. And that is exactly why phase 2 is designed. Phase 2 of this course is going to help you understand why and how to design your own system. Welcome to lecture number 1. Here we are going to talk about how to start building your system and what is step number 1 to building your own trading system. Let's get to the charts. So now, when I look at most people, and I am guilty of this mistake myself, when I look at most people, I see them trading random stuff, right? So let me just share my own example of how I used to trade. If it was the old version of myself, I would look at it, call it a double top, I would short right here, price would go down. Then if once again, if it was the old version of myself, I would call this a bear flag and I would short when it breaks here, or I would call this a double bottom, or I would long over here. So, and this is exactly how most people trade nowadays. This is exactly how most people think that they are going to make a lot of money. So I would call this a support region, I would call this a resistance region, I would long here, I would call this again a resistance region, I was short here. And this is incorrect. This is not how you are going to become profitable. This is not how you build a trading system. So what you need to do, the very first step of your understanding, is to make sure that you define the technicalities of your trading system. The base and the foundation of your trading system is your technicals. What is the technical factor that you look at in the chart and you decide to take a trade? That is something extremely important. So I'm going to give you an example. So for me, I mark support and resistance zones, and I have defined that only and only the support and resistance zones from where there is a significant move is what I consider a valid support and a resistance zone. That is called defining your technicalities. So for me, this is a resistance zone because there's a significant downside move here. For me, this might not be a resistance zone. Even though it used to be a support and now it is flipped, I might not consider this as a resistance zone because I have defined the definition of my support and resistance. And for me, this could potentially be a support because yeah, we did see some significant move up from here, but for somebody it might not, right? So this is extremely important. So the phase number one which you've been through, which is basically to make you understand what all exists in the markets and what all you can use to observe the markets and read the charts better. What you need to do is you need to spend enough time with those technicalities, and when you spend enough time on the charts with those technicalities, this is where the hard work comes in. Because once again, just because you've bought this course does not mean that you will become a profitable trader. The course is not a magic pill that you can eat and become a profitable trader. You need to work hard. You need to understand all the things I've explained. You need to practice all the things I've explained and taught to you, right? So what you need to do exactly now is use all the knowledge that I shared with you in the phase number one. If you did not understand, watch it again, take your time. The market is not going to go anywhere else. The market has been here before you were born, and the market is going to be here after all of us die. So don't worry about the market going anywhere. Don't rush the process. What you need to do is utilize all the knowledge that has been given to you in the phase number one. Try to read the charts. When you try to read charts, when you try to implement all that knowledge on the charts, what you will understand is there are certain things that you will observe about a certain asset, about a certain instrument, about a certain timing, and you need to grasp that as soon as possible. You need to grasp that and then build on that technicals. So I'm going to give you an example of what I exactly mean over here. So let's take Bitcoin for example. Now Bitcoin loves to sweep liquidity, right? Bitcoin, like I said, like I repeat, Bitcoin loves to sweep liquidity. This is a brilliant example right here. So we've got a support region here, right? What happened? Price was making a bullish structure, price came down, took all the liquidity, and now it went up a little bit. After that, obviously, yes, it dropped. But again, Bitcoin loves to sweep liquidity. Just like that, gold also sometimes loves to sweep liquidity. But again, if you analyze gold enough times, you will realize that gold is a type of asset that does not break a significant level without testing it 2 or 3 times. This is once again a technical factor that is valid on gold. So you can just use this factor and build a strategy on it, right? But for this, you need to spend enough time on the charts. You need to spend enough time using the knowledge that I have shared with you on the charts to come up with something technical, right? And I'm giving you an example as well. Once again, let me give you another example. So let's say if you talk about gold. So in gold, you will observe that whenever the New York session starts off, after around 9:30 a.m. Eastern time, 7 p.m. Indian time, what happens is gold gives a significant move, right? Gold, if gold is near a support or a resistance zone, it might give a significant move. Another technical factor that I can share with you is that gold, what it does is, if during the night, okay, so let me give you an example. So right here we've got a support region right here. The market came back down at almost 6:30 a.m. in the morning, early morning. The price held that zone for the rest of the morning, right? And then right after a few hours of London session, the price started going up. So this is also another technical observation that I made on gold, that if a particular support or a resistance zone holds overnight, in the coming London session, the price starts moving up or down from that particular region. The price starts to continue from that particular region. And once again, you'll see this happening multiple times. You can test it yourself on the chart. But once again, you will get all this information only and only if you spend enough time on the charts yourself. Remember, this course is to give you a roadmap is to give you the right direction in terms of what you're supposed to do, because without this course you might not even have the direction, you might not even know when to do what to do, right? So now after phase number 1, you are equipped enough to spend time with the charts, analyze the charts, test things for yourself, and observe how things work. And once you figure out the factor that suits you, like I shared with you, what suits me is the support and resistance zones from where there is a significant move that has been made. That is what suits me. So now I want you to figure out something like this, understand what suits you, and post it in the assignments section in the courses below. And once you post it in the assignment section, I will verify it myself, and I'm going to help you out build your own trading system. I will see you in the next lecture. The next step to building a robust system is going to be systemizing and making a systematic approach towards the instruments that you're going to be trading. Obviously, the first step, the first lecture when I spoke to you about technicalities, if you obviously spent enough time with the charts, looked at enough assets, you would have by now, if you actually put in effort, if you actually worked hard, by now you would have understood, or you would have identified certain properties about certain instruments or something like that, right? But now the next step is to systemize and make a systematic approach towards the instrument that you are going to be trading. I'll give you a very specific reason for that. You take a look at all the top traders in the world, or whoever you look up to, right? Any trader who's successful and you look up to, you will notice one thing common about them is that they trade only a very few and selective instruments, or sometimes even one single instrument, and they don't touch anything else. Myself, I trade only gold, sometimes Bitcoin, nothing else. I don't remember the last time. I think it's been more than a year and a half. I haven't traded anything else other than Bitcoin and other than gold. And that is for a very specific reason, because every single instrument has its own strengths and weaknesses, has its own characteristics. And I'm going to tell you something, and I'm going to give you a very simple example of what exactly I mean by this. Now, let's say I tell you that you download Tinder, you go on a date every single day with a different woman, every single day, right? What are the chances that you will get to know the woman that you're meeting very well? Very low chances, right? Let's take another example. The second example, I'll tell you that you have to spend a one whole year with one single woman. In this example, do you think you will get to know that person very well? Absolutely, because you spent a decent amount of time with just one woman, one person, and that automatically means that you will get to know everything about their character, everything about their reaction, how they behave, how they react in certain situations, and you will get to know that person very, very well. Instead of you spending a night or a date with a different woman every other day, right? And that is exactly what most of you do when it comes to instruments. You want to trade gold today, tomorrow you trade USD JPY, day after tomorrow you want to trade Euro USD, then you want to trade Bitcoin. This is not how you will get an edge in the market. This is not how you will get an edge over an instrument, because for you to understand characteristics better of any instrument, you need to make sure that you're spending enough time with that instrument. Otherwise, you will never get to understand anything specific. The reason I understand gold so well is because I've spent so much time just trading gold and analyzing gold, backtesting gold, and basically majority, in fact 99.99% of the time I spend it on gold. And that is exactly why I have such an amazing understanding of how gold works, because I've spent that much time with it. So now what you need to figure out is what instrument suits you the best and what instrument would you like to go ahead and trade with. Now maximum you can select up to 5, but I would suggest if possible you should select only 2 or 3 maximum. You should not go till 5. But let's say if you're very confused, if you still need some more time to figure out, select up to 5, and then from there move forward and understand what suits you the best. Eventually, as you move forward, as you start analyzing the charts, automatically you will understand what suits you the best and what is the instrument that you understand the best if you spend more time on it and enough time on it. And remember, till now you are not supposed to put in money and trade anything. We are still in phase number 2, right? We are yet to put in money into our brokerage accounts and take trades, right? So make sure you're not trading anything. All you're doing is just spending time on the charts. The more time you spend analyzing charts, the more time you spend understanding charts, the lesser the amount of losses you are going to make, right? So now your number 2 task of phase 2 is to understand, analyze, spend maximum amount of time with the instruments that you feel that suit you the best. Maybe you are in a position where you already have identified that instrument for yourself, well done, perfect. Now what you need to do is upload your assignment number 2 here, and I would like to see that which instrument have you identified for yourself, what characteristics have you identified about that particular instrument which you understand very well, which is going to be your edge in the market. And after that, I will see you in the next lecture. About multiple things. We've spoken about technicalities, we've spoken about your personality, we've also spoken about your instrument. If you've already done these 3 things properly, then I am very sure that you are getting very close to building a proper system. Now don't worry, if you're wondering whether you're doing it right or not, you always have the assignment section where I will be helping you out, and I will approve whatever the work you are doing, and I will help you out with whatever weaknesses that I see in your system with my own experience. So you don't have to worry about that. And by the end of this phase number 2, I will be sharing with you an example of what a proper system should look like. But this is going to be the most important part of phase number 2, which is building your risk management system. Your risk management system is extremely important. You might have the best strategy in the world, but if your risk management system is not proper, you cannot become successful in trading. And you might be wondering, what is more to managing risk? Let me tell you what is more to managing risk. Now, a lot of people think that just managing 2% risk every particular trade is enough. That is not enough, my friend. There are multiple things that you need to take care of, because in your system, you will come across a lot of different variations and different variables which are going to challenge your system, which are going to challenge your thought process and your trading psychology. And that is exactly why you need to build a robust system on risk management for you to understand better what is exactly to be done. Now, let me give you the basic thumb rules of building a risk management system. Now, the very first rule is going to be that under no circumstances you are going to risk more than 2% of your capital. So this should be the red line of your system. This red line should never be crossed. No matter what happens, you are never going to risk more than 2% of your trading capital on a particular trade. Now, this basically means that you will never ever blow up your account if you follow this particular rule with discipline. But now, coming to the next part is your risk to reward ratio. Now, I have already told you what is the risk to reward ratio in phase number 1. What you need to understand is, now whatever system you're trying to build, you need to also define your risk to reward ratio. What is the risk to reward ratio that you are looking at? Now, the minimum risk to reward ratio that you should be looking at is 1:2. I personally believe it should be 1:3, but for starters, it should be 1:2. Anything below 2 is not good. It should not be part of your trading system. Basically, this means that if you are risking 2% per trade, your profit should be 4% per trade of your trading capital. So if I have $10,000, I will risk $200 to make $400. This will ensure that even if I lose one trade and I win one trade, I will still be net profitable. And this is something, once again, that should be the basic thumb rule of your risk management system. Now, what exactly do you need to build? Because I'm sure that these thumb rules you already know. What you need to build is, this is something that might not make sense to you now, but it will make sense to you when you start backtesting your system, which is phase number 3. When you start backtesting things, you will come to realize, you will come to a realization that a lot of things are a little tricky, a lot of things are a little variable, and you will realize that, I don't know what I would have done in this situation. And that is exactly why you need to build on your risk management. So this lecture, if you're watching it in sequence, if you're not skipping through the course like a maniac, this might not make sense to you right now. But trust me, when you watch the phase number 3, you are going to come back to this and you will watch this lecture once again. But like I said, what you need to build is certain rules that are going to make sure that you are always net profitable at the very end. So let me give you an example. So in my system, what I like to follow is, now I am a trader, I'm an aggressive trader, and I'm also a defensive trader at the same time. But what I want to do is, the first thing as a trader I would like to be is defensive, because first I want to put myself in a spot, I want to put myself in a situation where no matter what happens, I come off at least break even, right? So the very first duty that I have as a trader is to cut my losses and to be in a position where it is impossible for me to lose, right? So what I have made a rule for myself, that the moment a trade of mine achieves 1:2 risk to reward ratio, I immediately trail my stop loss to break even, trail my stop loss to my entry, and book half of the profits. That basically means, if I am in a particular trade, let's say my stop loss is $2, if that particular trade goes $4 in my profit, what I do is I exit 50% of my position position and I bring my stop loss to my entry level. So worst case scenario, even if the trade comes back to my entry and hits my stop loss, I will still be in a net profit of 2% of my trading capital, right? Let's say good case scenario. Worst case, not we talked about the worst case, now let's talk about the best case scenario. Best case scenario, the trade continues to go higher and higher and higher and achieves my, let's say my target was 1:4, it achieves 1:4 and gives me almost 8% on my trading capital. So this secures me in a very good way. It ensures that even in the worst case scenario, I still come out net profitable. While actually, I also agree that the worst case scenario would be the trade directly taking my stop loss. But once again, if you're building a proper system, you will have a higher accuracy rate. Once again, that is going to come with experience, that is going to come with a lot of backtesting and practice. And don't worry, I am going to be there with you until you make that happen. I will be there to help you out with your assignments. But what you need to do is build a robust risk management system, because risk management is where most people, end up blowing their accounts. Why do people blow their accounts? Because they are not prepared for certain situations. Let's say you take a certain trade, the trade goes in your favor, the trade goes extremely well. Now most people are not planned for this. Most people are not planned to hold big winners, and that is exactly where rules like these come in handy, because the only reason why you get scared to hold winners is because you don't want to lose all the profits that you made. But let's say you follow the rule that I just shared with you, you are now in a position where worst case scenario still come off with 2% returns on your trading capital. So then you become extremely comfortable holding that particular trade for a very, very long time, and that trade also comes in a position to give you a decent amount of return on your trading capital, right? So this is something that is extremely important. This is something that is going to potentially help you out. Now this is just one rule. Now I want you guys to brainstorm, I want you guys to apply your own brain, and I want you to work on a risk management system. Whatever system you've built so far, which is obviously incomplete as of now, I want you to work on it and brainstorm what could be the potential risk management rule that I want to involve in my trading system, because this risk management tool is going to help you out in multiple ways with your trading psychology as well. A lot of people blame their trading psychology, but actually they don't have a proper risk management system. Let me give you a very interesting example. If I am driving a car and the brakes fail, if I am trained, if I am prepared, if I know the risk management, if I know exactly what to do when the car brakes fail, I will not panic. I will have a plan, I will have a roadmap. The reason people panic and the reason people don't have any idea what to do during certain situations in trading is because they don't have a plan, because they don't have a system on risk management. And that is exactly why a system on risk management is extremely important. So what you need to do is you need to define, first, obviously it is defined already that 2%, not more than 2% you're going to risk. Second, you are not going to take any trades which are giving you a risk to reward ratio of less than 2. Third, one tip that I just shared with you is something that I do with my personal system is 1:2 is the minimum I look at, and when it is achieved, I exit half of my profits and trigger my stop loss to break even. Worst case scenario, I come off with 2%. Best case scenario, the trade keeps going in my favor and half of my position is still running in profits and making me more money for the future. So this is just another example. You can come up with several things. You can come up with several strategies like this to put yourself in a situation where you are going to be net profitable no matter what happens. This is going to be a game changer for you if you actually work on it. Like I said, you don't expect spoon feeding here. Don't expect me to come and do things for you, because I want you to be an independent trader. I don't want you to be dependent on me. I want you to learn from me. I'm giving you the direction. You put in the effort. I am there to support you. I will look at your work. I will look at the assignments. I will approve them or I will reject them just to make sure that you're on the right path. So in this lecture, I'm going to be talking to you about another very important element of your trading system, which if not done properly can lead you to losses. Everything can be just fine, but if this particular element is not present, if you're not doing this properly, once again, your trading system cannot be profitable. And we are talking about execution over here. So a lot of people don't have an execution system built, right? You need to have an execution system built which defines and systemizes the way you enter trades. You need to have a certain criteria of how you're going to enter in a particular trade, and that is very important, because otherwise if you don't have a execution system ready, the chart can do anything and you will have no idea when to enter, when not to enter. This will result in random trades, this will result in revenge trades, this will result in unplanned trades, and then eventually you're going to make a lot of losses. And that is exactly why this is extremely important. So what I'm talking about here is building an execution system. Now this doesn't have to be extremely complicated, but it needs to be simple and it needs to be there, right? So this can be as simple as a particular candlestick pattern that you're looking at before entering a particular trade. So let's say your system, the technicals you're building on your system is basically support and resistance. Now your execution system can be a hammer candle or a shooting star candle if it is a resistance, a hammer candle if it is a particular support region, right? Which is basically once again an imbalance of power amongst the buyers or sellers. This is something that can be there. A bullish engulfing pattern, any candlestick pattern can be this. Any chart pattern, small chart pattern, maybe a double top pattern or double bottom pattern on the 1 minute time frame, 5 minute time frame, doesn't matter. But if you're watching this, by the end of this phase 2, you need to have a system ready, and by the end of this phase, obviously I'm going to be sharing a whole ready-made system for you as an example, so you understand what exactly I'm talking about. But make sure if you're watching this lecture, by the end of this phase number 2, you have an execution system ready, which should have a defined entry system, a defined way of entering, and a defined way of placing your stop loss. The very last module of phase number 2, and that is going to be timings. Now, as a trader, you need to define your timings. You need to define the amount of time or the period of time that you're going to spend trading the markets. People don't do this, and that's exactly why they act oblivious. They have no fucking idea what they're trading. They have no idea when they're trading, and they have no idea what exactly they're doing, because they don't have a set period of time in terms of what they're going to do. And that is exactly why you need to set a specific amount of time, which is very strict, and you are going to decide not to trade out of this particular time zone. Let's say, for example, I would like to trade between 7 p.m. Indian Standard Time to 12 a.m. midnight Indian Standard Time, which is basically 9:30 Eastern Time to 3 p.m. Eastern Time, which is basically the New York session, right? And why did I finalize this particular time? Because there is a lot of liquidity in the markets. There is a lot of moves in the markets. Now, when you spend enough time looking at the charts, analyzing the charts, you will realize that there is a certain period of time, only a certain period of time, where the market gives a lot of moves and most of the opportunities. And this might be something you will come to realize, or you will realize after you backtest your strategy. Once again, this doesn't have to be decided before you backtest your system. Once again, I realized my specific timings when I decided to backtest my systems. But as a rule of thumb, this needs to be very clear in your head that the time period you are going to trade the markets or you are going to take your trades should be fixed. Because if you decide to take trades at random times, you are going to take unplanned random trades, which are eventually going to lead into losses. This is once again a very big contributor, which is going to help you out to avoid unnecessary trades. So what you need to understand is, once again, if you are an experienced trader, if you have some or the other experience in trading, I want you to go to your trades, go to your history of trades, and check what is the most common timing for your trades, and you will realize that most of your opportunities that you're getting, they share the same amount of time, they share the same time zone. And that is exactly how the markets work, because the markets are going to give you an opportunity in a specific time window, and you need to do that, and you need to follow that consciously, which is going to help you out a lot in terms of not over trading, not taking unplanned trades. And this will also give you a lot of peace of mind, because if you don't have a defined time period, you, like a maniac, look at your phone every single second, checking the charts like you're going to get some golden opportunity, which obviously you're not. So you are also going to get a lot of peace of mind if you define the timings that you're going to trade. In this lecture, you are going to have your aha moment, you're going to have the eureka moment, you're going to figure it out all, because you've been watching phase number 2 and you've been trying to figure out what the hell is this guy telling me. If you're a beginner, you would have probably got that thought, but trust me, this lecture is going to clear it all out, because I am going to give you one of my profitable trading systems, one of my profitable trading strategies which work and which I am personally using to make thousands of dollars, and I'm going to share a trade I took myself with you to show that it works. Let's get to the screen. So here I've written down my entire trading system. Let's go through it and read. So if you remember what you've learned in phase number 1, you need to figure out your technicals, you need to figure out your instruments, you need to figure out your personality, you need to figure out the timings, and based on all of that, you need to figure out your execution, you need to figure out your risk management. And once you combine all of that, this is something what you get. This is what it should look like, right? So let's get to the screen and read. So the first step is to find support and resistance levels on gold with a top-down approach. Once you analyze and to do a top-down analysis, you should develop a bias. Developing a bias basically means understanding whether you're going to go long or whether you're going to go short on that particular day. Developing a bias is extremely important because if you trade without a bias, you're going to be confused and you will not be able to do both. Draw zones on 1 hour time frame and 30-minute time frames. Execution zones on 15-minute and 5-minute. This basically means that the zones where I'm going to actually execute my trades are going to be drawn on 5 minutes and 15-minute time frame. Trade only pre-London, which is 11:30 a.m. IST to 1:30 p.m. IST. So I've defined my timings very specifically, very well. If there is no volume in pre-London, then wait for London or else call it a day. If there is no volume in the pre-London session, I will wait for the London session or else I will stop trading for that particular day, because this is going to give me a next level of peace of mind, because I don't have to worry about what the hell is going on in the New York session. I have defined specifically my timings for the day. If I get a trade during that time, perfect. If I don't, I should not care, because unlike most of you guys who don't follow a trading system, you are in front of the fucking screens all day like a freaking nerd and you forget to live life. You're not going to become a profitable trader like that. You need to specify your timings, and that's why it's so important. Execute trades on break of structure in 5-minute or 15-minute candle close, whichever is stronger. This basically means that once a 5-minute or 15-minute zone breaks, I get a candle closing, I will execute my trades. Target the next price rejection. Minimum 1:2 risk to reward ratio should be there. Trade stop loss to break even at 1:1 risk to reward ratio. Stop loss above previous 15-minute candle. If price permits, then above current 15-minute candle. So this basically means that my stop loss is going to be above the previous 15-minute candle. If price permits, if the stop loss is too large, then I will keep my stop loss above the current 15-minute candle. So let's go to the charts and actually see this in action. So here we are at the charts. Now, straight up looking at the daily time frame, I can see there's a support. On the 4-hour time frame, I can see that gold is in a downtrend, which is lower highs and lower lows. Quickly analyzing the 1-hour time frame, I can see a resistance right here. If you're worried how am I marking these zones so quickly, I've been doing this shit for 6 years. Don't worry. The more you practice, the better you'll get and the faster you'll get. So don't worry about that. On the 30-minute, okay, on the 15-minute, I can see that the price is sitting at resistance. What time is it? It's around 8 a.m. in the morning. So let's wait for price to form a structure. Alright, so I can see that there is a small support region right here. So if price breaks the support region, that would be a break of structure as well as a break of support zone, and that would confirm a reversal, or I would rather say that would confirm a continuation in the downtrend, as from all the higher time frames, gold is in a downtrend. So this is my execution zone on the 15-minute right there. If this zone breaks, let me just refine it there. This would be the perfect zone, because there's this candle has a wick over there and we don't want to entry early into a particular trade and then get stuck. So let's go down to the 15-minute candle, and like I said, if a 15-minute candle or a 5-minute candle closes below this particular zone and it closes nicely, we will enter. Our stop loss is going to be above the previous 15-minute candle, and our target is going to be the next rejection level. So the next rejection level is clearly this. This is the next rejection level, right? So this is something that our trade should look like. So let's wait for the market to give us a trade. So the price is coming down. Price went back up again. So now this is a very good confirmation. If you actually look at it, the more the price bounces away from a support, the faster it will break the next time if it actually breaks. So we are going to just have to wait patiently for the support region to break. There we go. But the candle didn't close. So let's say you entered on this particular candle which has closed below this support region. So let's take a short position right here. The stop loss would be above the previous 15-minute candle, which is this, and the target would be the next rejection level. Let's say for safety, I would say 2312. That's a risk reward ratio of 1:3. Let's see how the trade plays out. So the trade straight up smashes into that take profit, and that's exactly what happened with me. I made $6,300 on this particular trade. Here's the proof, here's the screenshot, here's the execution following this exact system. So my friend, here is how simple it is actually to build a trading system. If you know exactly what you're supposed to build, if you know exactly what you're supposed to focus on. If you want to copy my system and trade it, you be my guest. I shared it with you for a reason. Now I hope you have a very clear-cut idea in terms of what exactly you're supposed to do in terms of building a system, what it should look like. But the most important thing, see, I know most of you are going to copy the system, are going to try to trade it, but The real game is not in the system. The real game is over here, and the real game is how you do it with how much discipline. I follow this with 100% discipline, with 100% dedication, and I follow all my rules strictly. That's why I'm able to trade profitably. Doesn't mean that you will also be profitable by this, because I don't know how disciplined you are and how strictly you follow your rules. So don't run after this. Yes, it does work, it does make money, but you should run after the concept that I've taught you. I've taught you how to fish. Don't run after the fish. You should know how to fish. You should focus on how to actually build a system and take inspiration from this. Use this as an inspiration, use this as a reference. Don't take this and try to run away into the market and try to become a millionaire. That's not going to work, because this is just a small piece of information from my side. This is just for your reference. It does work, I'm not denying that, but I hope you get the larger picture. I hope you get the point. If you want to become a successful trader, you need to become independent. You don't need to be dependent on me and my methods, at least for the rest of your life. Alright, so in this lecture, I am going to be talking to you about how to backtest like a pro. So I'm going to do backtesting right in front of you and show you exactly how you're supposed to backtest. What are the things you should keep in mind? What are the do's and the don'ts when you backtest, and how do you actually start? Because trust me, backtesting is the most boring thing you will ever freaking do. But it's important and it makes you money. So I guess you have to do it, right? So let's get to the charts. So first of all, when you're doing backtesting, there are two important things that needs to be right in front of you, whether it's written down on a piece of paper or whether it's on a different window on your computer. So the first thing you need is your trading system, so that every time you look at the trade, every time you look at a trade appearing in front of you on the charts, you can always read it and verify it whether it fits your system or not. See guys, I'll tell you something very important. Backtesting, and this is something that nobody talks about. In backtesting also, your trading psychology is extremely important. In fact, if you cannot have a proper trading psychology in backtesting, you will never have a proper trading psychology in the real life market, right? And what do I mean by trading psychology in backtesting? I mean that a lot of people, when they're doing backtesting, they lie to themselves, because eventually, even in backtesting, what people do is they take trades that are out of their system, that doesn't fit into the rules of their system, and in fact, just to feel good that, you know, if they see that a trade is doing well, if they see that a trade is going in their favor, they would just write that down into a piece of paper, and in fact, they would make a set of incorrect data. Now, if you're going to make a set of incorrect data, it is going to give you incorrect results. It's going to damage you. So the number one and the most important rule of backtesting is be honest to yourself, and always have these two things right in front of you, which is your trading system and your backtesting template, which I have given you, which I have shared with you. So when you're backtesting, how do you start, and how do you exactly go about it? So I have the TradingView premium version. You might not be able to do it on TradingView, but there are multiple free platforms that you can use. I will research about them, and I've never used a free platform for backtesting, so I'll research about them and I'll put the link below so that you can backtest for free. However, I would really suggest that if you're really serious about your trading journey, then I think spending a few $100s on your trading software is not going to be a big deal. In fact, it should not be a big deal, because if you're treating this as a business, this is just your costings, this is just your expenses, right? And that should be taken very, very seriously. So how do you go about it? So I'm going to start backtesting from the 1st of January. So how do you backtest? So like I said, you need to have your trading system right in front of you. You read that and you backtest accordingly. So I'm going to backtest the same trading system that I gave you in phase number 2. So now you know what my trading system is, right? So I'm going to go to, so this is 29th of December. I'm going to play this, and here we go. We are at, all right, I moved too fast. All right, so that's 6 a.m. This lecture might be a little long, but stick with me. I'm just going to show you 2-3 trades. I'm just going to backtest 2-3 trades and show you. You'll get a fair idea of how exactly you're supposed to do it. So there we go. That's 9:30 a.m. That's 10 a.m. right? So 10 a.m. is exactly when I trade. So I'm going to do this. All right. So now this is the perfect chart. This is the perfect morning chart that I'm looking for. So what I'm going to do is I'm going to go to the 4-hour time frame. Let's go to the 1-hour time frame. I'm going to develop a bias. So now, if I, let's say, go to the daily time frame or in the higher time frame, I can clearly see that there's an uptrend, right? The price is moving in an uptrend. There's a structure of higher high and higher lows. So my bias should clearly be bullish in this example. So let me just draw some support and resistance levels. So this is a zone on the 1-hour time frame. Let me go to the 30-minute time frame. Yes, that's a support region. I can see that the price was taking resistance here, which it has now broken above, which is also very interesting. On the 15-minute time frame, I can see that the price has broken above this resistance, and now it's forming some structure right here. And on the 15-minute, I can call this a resistance as well. So this is something that is interesting. So let's say if the price breaks above this level, so now it's time to draw the execution zone. So I can clearly see that there's the price broke this particular level, but it is struggling to go up. But the fact that the price is going above, it has formed such a bullish structure. If you look at this, so if you remember something I told you, that if a price is trying to break a zone multiple times, that could potentially be called as an A plus setup, right? So you can see the price has tried to break the zone multiple times. So now I just need to wait for this break of structure. Once this breaks, this is my execution zone, I can enter, right? So what I'm going to do is I'm going to draw an execution zone right here. So once this zone breaks, I will immediately enter, okay? So let's see. There we go. So here I will be, let's say, so normally as per my system, I would take an impulse entry over here. An impulse entry is an entry right at the break, right after it breaks right above at this particular level. But obviously for beginners, I don't suggest that. I suggest that you enter only at a candle confirmation. So let's say you enter over here at this particular candle confirmation. Your stop loss would be below the previous 15-minute candle, just right here. Now let's say if this stop loss seems too big, right? This, according to this particular target, the stop loss seems too big. So what I'm going to do is I'm going to keep a stop loss right below this 5-minute candle. So that still gives me a risk reward ratio of 1:1.8. And let's see how the trade goes. All right, so the trade is pretty slow. All right, so the trade decided to hit a freaking TP right in the other candle. So now this is what happened, right? So now what I'm going to do is first of all, I'm going to look at my trading system. Trust me, guys, you need to do this for at least first 10-20 trades that you backtest. And once you do that, you will develop a next level of discipline there where you will never have to do this ever again. So just trust me on this and just follow what I'm telling you. Okay. So once you've got your first trade, once you've backtested and you've got your first trade, don't be happy. No, you haven't figured it out yet. You need to do this hundreds of times. Just be patient. Okay. Keep patience. So you go and read your trading system. Did you follow each and everything that is written over here? Okay. Find support and resistance levels on gold with the top down approach. I did that. Develop a bias. I did that. Draw zones on 1 hour 30 minutes. I did that. Execution zone. I did that. Trade only pre-London. Was this trade executed on pre-London? So this was 9 a.m. Dubai time, which is not pre-London. So what I'm going to do is delete. Doesn't count. This trade doesn't count. Even though I feel extremely happy, even though I feel, oh my God, I got a 1.8 RR and this trade hit my freaking TP in just 50 minutes, doesn't count because this doesn't fit in your system. And why do you have to be so strict about this? Because my friend, if you're going to consider trades in your backtesting data which actually don't fit into your system, you will never be able to come out with a pure set of data. Okay, so you need to be very strict with this and control on your psychology. Stay disciplined. Okay, so I'm not going to count this because the pre-London starts at 10 a.m. Dubai time. So now, once again, this is also resistance. So if this resistance breaks, yes, there is an entry that I can make because the price is almost about to break. And the next rejection level that I see is this level. So maybe I can take this trade, right? So let's see. Now in this case, the price has not tried to break this zone multiple times. So I would like to wait for a 5-minute to 15-minute candle confirmation. Let's see what happens. All right, so price is correcting, price is coming down. All right, so here we go. We've got our, I think we've got a 15-minute candle close as well. I've got a 15-minute candle close. Let's say I go long here. Okay, let's say I go long here. My stop loss, let's say, is somewhere over here. Ideally, in this example, I would keep my stop loss here. This is where my stop loss would be, below this candle. I don't mind keeping it below this candle as well, but this candle is perfect according to me. Now let's keep the target at the next rejection level. So this is a perfect 1:2 trade, right? Let's see what happens. There we go. There we go. Took out a stop loss, right? Again, even though if it's a stop loss, what are we going to do? Find support and resistance levels on go top down approach, develop a bias. I did do that. All of it. I did do that. Trade prelim. I did do that. Execute trades on break of structure on 5-minute candle or 15-minute candle. I did do that. Target the next price reaction level. I did do that. Trail SL, it never went in my favor. SL above or, let me just edit this. SL above or previous 15-minute candle if price permits. Above or below. Let me just edit it quickly. Yeah. So stop loss above or below previous 15-minute candle. Okay. So did I do that? No, I did not. My stop loss should have been this level. Now, if I did that, then the trade would not have given me a 1:2 risk to reward ratio. So what I did here is I forced myself to keep a shorter stop loss so that I could get a higher risk to reward ratio. But eventually what happened? I lost the trade. So actually, if I was just disciplined to the system, I would not have taken this trade and I would not have made this loss. Do you understand what I'm trying to tell you? I made this mistake purposely so you can understand how to backtest properly. Okay, so you need to have your system written down always in front of you when you're backtesting, because that will keep you in check and that will keep reminding you, my friend, that brother, this trade, brother or sister, whatever you are, this trade is part of your system or not. Okay, so I'm going to discard this trade out because I did not follow this. And there goes the pre-London session, and I'm not going to be trading this, okay? Because according to my system, the session is over, pre-London session is over, so I am not going to be trading for the rest of the day, and I'm going to be calling this a day. So let's wait for the next day, which is the 3rd of January, and see. So I like to delete all my zones and start off fresh. Okay, so let's go to the daily time frame. All right, so we are on the daily time frame, and we can see that the price is correcting prices on the lower high and lower low structure on the shorter time frame. However, on the higher time frame, it is on the, so this is a daily support that I can spot. But if this breaks, this would form a head and shoulder pattern on the 4-hour time frame, and that would mean that gold is interested in going down. So let's see. Let's fast forward this to the next morning. I hope all this is making sense to you. If it's not, you need to watch all the lectures again. And if none of this entire course had made sense to you, you need to go and watch 0 to Alpha 1.0, the first version of 0 to Alpha, all over, and then come to this version, because this is a little bit advanced. All right. Just waiting for the morning. There we go, 9 a.m. All right, so we've got 1 hour to trade. So let me draw my execution zones. So I can see that there is a, let me go to the 30-minute time frame. I can see that there's a rejection zone here. I can see that there's a rejection over here. I can see that, let's go to the 15-minute time frame. I can also see that there's a resistance over here. And price could potentially break down this because there's a small support forming, and the bias can be considered as bearish. So I would like to draw a small support over here. If this support breaks down, I will go short. I don't want to go long in this scenario because price is correcting on the higher time frame. So my bias for today is bearish. Okay, so I formed my bias with the basis of the higher time frame analysis. So what I would like to do is I would like to short in this scenario. Let's see what happens. Okay, price is coming down. It's not 10 a.m. yet. Beautiful, beautiful. Okay, so this is a lovely structure. Okay, price has formed this structure again and again. It has tried to break this support region again and again. So if the zone breaks, that's going to be a A+ setup as per my system. Okay, so let's see if it actually breaks or not. Beautiful, beautiful. So let's see if it's a 15-minute close.
Okay, so in this scenario, I would even enter, because like I said, this is an A plus setup, I would enter directly. Let's say you enter over here with a stop loss above this green candle, above this red huge candle, okay? Your target will be the next rejection zone. So let's go to 30-minute. This is the last rejection level from where the price rejected towards the upside. So this would be your target, which is a beautiful 1:2 risk to reward ratio. Let's see what happens. Oof. All right. So, what do you think? What is the first thing that you will do? The first thing you should do is go and read all of this again. Now, there's only one rule that could have possibly be broken on this one. I want you to take 5 seconds and think which rule could that be. 1, 2, 3, 4, 4.5. 5. If your answer is rule number 7, you are correct. That is the only rule here which could have been broken, because I followed everything else properly. So let's see. So my stop loss here was 20 pips, right? 20 pips was my stop loss. So that means 20 pips is 1:1 RR. The trade did not go in 1:1 RR. So basically what I'm trying to say is that in a real life scenario, if this trade would have gone in my favor, I would have achieved 1:1 risk to reward. I should have trailed my stop loss to break even, right? And if I would have trailed my stop loss to break even and it would have come to break even, I would have gotten out of this trade with no profit and no loss. But did that happen? No, it did not happen, because the price did never achieved 1:1 risk to reward ratio. It actually went up before achieving 1:1 risk to reward ratio and then came down and took my stop loss. Sorry, took my take profit. So is this a valid trade? Absolutely. So I am going to go finally to my backtesting data and I'm going to add this over there. Okay. So my entry was at 11 a.m. 3rd of January. So I'm going to write here 3rd of January 2024. The direction was short. I went short. My entry was 2062.456. Just two decimals are fine. My stop loss was 2064.46. My exit was 2058.22. 2058.22. My returns, it was a win. The returns were somewhere around 4.22%, because it was a 2.11 RR trade. So the returns would be 4.22%. Notes. Now this depends totally on you. Now if I was in your situation, I would just ask myself. Now this is where the tricky part comes in. This is where, again, you have to really trust yourself and you have to be very honest to yourself. Now I'm going to ask you this question, okay? And you have to answer honestly. If this trade went in your favor, a little bit like it did over here, and then went up and almost took out your stop loss, would you still hold it till the TP, or would you panic and get out? And if the answer is you would panic and get out, write down in the notes, learn to hold trades. Stick to your, okay, fuck. Oh shit. Learn to hold trades, stick to your stop losses, be disciplined. So you know that in a real life scenario, you would be shitting your pants if the price came back to your break-even level and almost took your stop loss. But in the reality, in the backtesting world, you are celebrating because you hit your take profits. This is not something to celebrate. This is something to work upon. So, but the best part, my friend, is that if you do this 100 times, guess what? You will truly develop confidence to hold trades in the live markets, because you know that if I just stay disciplined to my stop loss, the market might just reward me. But imagine you did this without any backtesting data, without seeing that this could also happen. You would be shitting your pants again, and without even realizing what is the solution. And this is why backtesting is so important. This is how you backtest, right? So again, I'm going to repeat. what you have to do is you have to be extremely honest to yourself. When you're backtesting, you need to have a system. The moment you find a trade, you think you found a trade. After you found that trade, after you marked all the entries and all of that, you need to go back, you need to see. Okay, you need to read your system again and check if it fits every single rule. If it does, perfect, go here and make an entry. But still, there might be some notes that you want to make, that might be some real life scenario. So after you're done, you need to ask yourself that if I was actually in this trade, in the live market, what would I do? What would be my thoughts? How would I be thinking? So that you know that what you're supposed to work on, right? So my friend, this is how you backtest like a professional trader. You need to be extremely honest to yourself. You need to be extremely disciplined to your system, to your rules, and then only you will be able to come up with a good amount of data. And when you come up with that backtesting data, then trust me, you are going to have so much knowledge about your own system and so much knowledge about yourself, because you will ask yourself after every trade that what would I do actually in this particular trade if I was in the real markets? So that by the end of 100 trades, can you just imagine how much data would you have about your system and about yourself? You will know exactly where you're messing up. You will know exactly where you're getting fucked. You know exactly where your thoughts are being disaligned. You know exactly what major mistakes you're doing. And you basically know what to work on. But the problem is most of the traders is they don't know what the hell they should work on because they're just confused. So backtesting is going to give you a very good picture. But for that good picture, you need to be extremely honest to yourself and follow the exact method that I have taught you. I will see you in the next lecture. To talk to you about how to actually extract data from the backtesting that you've done. Okay, and I want you to write this down. I want you to note this down, that the things that we are going to look for from the data is accuracy, the timings, the risk to reward ratio, the trade frequency, where you're winning the most, where you're losing the most. So I want you to understand. So first of all, what we're trying to do here is, the first thing that we did was build a system, and then next thing that we're doing is backtesting it, right? Now, what is the goal? What is the end goal of backtesting? So obviously the first and the most primary objective of backtesting is to actually freaking understand whether this strategy that you've built, whether it works or not, right? And then when you realize that it does work, secondary objective is to polish it, is to make sure that you improvise on the strategy, that you make it even better and better and better, so that you eventually become the best version of yourself, and eventually a profitable trader, right? But let's not go there because that is secondary. So let's talk about what is primary first, right? So yes, I did give you a system to understand as your reference, but since I don't want you to be dependent on me completely, I'm going to talk to you about things in much more detail from the very start. So let's say now I've told you in this phase number 2 that you have to define certain things, right? Now let's say you define those things. Now how do you know that that's perfect for you? How do you know that that is exactly what you should do? And that's why we are going to do backtesting, right? So when you do backtesting, when you have, let's say, 100 set of trades, 100 data sets and 100 trades that you have on your sheet, where you've written down everything properly with the step and the process that I've shared with you in the previous lecture, where I was talking to you about how to do backtesting like a professional. Considering you followed all of that, you should have a good set of data of backtesting. And that data overall should tell you whether whatever you've made, does it even freaking work or not, right? If it works, congratulations, you've built a system that at least on the backtesting side, it is working, right? So that's one good achievement. But let's say it doesn't work. Let's say worst case scenario, it doesn't work. So what are you going to do to improvise it? What are you going to do to make it work? Because that is the most important thing, right? Now, every single time I'm not going to come and give you a system, make you sit on my lap and tell you that, my friend, here's my trading system, go and trade. You don't need to go ahead and backtest, right? That's not going to happen all the time. So you are going to be ending up with, sometimes you are going to end up with certain systems which are not going to work. So how do you make things work, right? So like I said, the first thing that you're going to look at is the timings, the days of the week. Now, what are these two data points going to give you? These two data points are going to make you understand that what are the timings where you are getting the maximum amount of trades, first of all. Right? So the first thing that you need to understand is, what is the time zone? What is the time window where you're getting the maximum amount of trades? So we've got our data over here right in front of us, and I've showed you this data earlier as well, that now if I have 100 trades right in front of me, what I can do is I can clearly filter out that what are the time zones that I'm getting my trades. Now the first step is to identify that. So let's say now, looking at this particular data, I figured out that, you know what, during the London session I'm getting trades between 10 a.m. to 2 p.m. maximum. So 80% of my trades during the London session were between 10 a.m. to 2 p.m. So now I have a window that 10 a.m. to 2 p.m. is where I'm getting 80% of my trades. Now, does this mean you should trade that window? No. Now what you have to do is, since 80% of your trades are in that particular time window, now you have to see how much are you winning. Now inside that window, there is going to be a certain smaller window where you are going to be getting winning opportunities more, and there's going to be a certain window where mostly you will be losing. So now you have to figure that out as well. So now since 80% of your trades came in that particular window, you have to go into that window and see how many were profits and how many were losses. Now, let's say majority were losses. That basically means that, my friend, that window is incorrect. That basically means you are trading the wrong time frame, or probably your system is not made for that particular session because you're losing majority of your trades, right? Or वैसे तो something like this should not happen in the first place, but if it is actually happening, that means you have made some mistake in building your system altogether. So you need to go back and watch phase number 2 all over again and build your system properly. But let's say you find something. Now in that time frame, you will realize that there is a certain time zone, there's a certain window which is like 1 hour or 2 hours where you're getting maximum amount of trades, right? So the system that I shared with you, how did I understand that only within these 2 specific hours is where I get my opportunities? Because I freaking backtested it. I backtested it so much that first of all I realized that between 10 a.m. to 3 p.m. or 2 p.m. where the entire London session and pre-London session is there, the maximum winning opportunities that I was getting was between 10 a.m. to 1 p.m. And that's why I decided to make that my window, right? I hope you're understanding what I'm saying. So what you need to do to improvise is, first of all, decide when you're looking at your data, understand the time windows, right? That is the first thing. Second thing that you have to understand is the days of the week. So I'm telling you, when you look at your data, now once again, this is only going to make sense to you if you have honestly followed what I've told you, if you have honestly prepared a sheet, if you have honestly backtested. If you're just skipping through this fucking course, none of this is going to make sense to you and you have wasted your money. I'm telling you again, it's not too late. Don't waste your money. Don't skip through this fucking course. Just watch everything properly and implement as I'm telling you, and you are going to end up profitable. I'm not going to say anything. I get very passionate sometimes. Please forgive me. But I just hope that we all can agree that I'm freaking hilarious. Anyways, coming back to the point. The point that I am trying to make is that if you do this properly, you are going to end up becoming a profitable trader. Okay? So now second thing, which I was talking about, which was days of the week. So now when you look at your data again, I'm again hoping that you have implemented everything properly. When you look at the data again, you will realize that there are certain days of the week where you get more opportunities, and there are certain days of the week when you trade, 80% of your trades are going to end up in a loss. And such days are normally Mondays, Fridays, and Thursdays. These 3 days, most of the time, if you trade, you are going to end up in a loss because markets are irrational. Now, once again, this does not apply to every strategy, but it does apply to my strategy, so I'm telling you from my experience, right? Now, let's say you are a fake out trader. Now, for you, Thursday and Friday might be the best possible day because on those 2 days, you get the maximum amount of fake outs, right? Monday might be once again the best day for you because Monday we also get fake outs in the London session. So what you have to do is, according to your strategy, according to your system, you have to improvise and understand that, okay, I'm looking at these days, I'm looking at this data set of 100 trades. What is the days of the week where I'm getting the maximum amount of wins? And my friend, that is what you have to note down. Okay, so you have to note down that these are the days of the week where I'm getting the maximum amount of wins. And then you have to go back to the charts and see what is it that is happening on those particular days and why are you making money on those days. Perfect. So these are 2 major things which is going to give you immense clarity on your system. Trust me, you will feel like you've figured out the 8th wonder of the world. Trust me, it's that good if you just do it properly. Okay. Third thing is, you need to understand that whatever trades you're taking, okay, what could you possibly do in terms of the execution to make those trades more profitable? Okay. So like whenever I look at my trades again, whenever I look back at my trades, whenever I look at backtesting, I also learn a lot of technicalities. I also learn a lot of technical pointers about my strategy and my system, which make a lot of sense, you know. So like, for example, one of the lessons that I got was, if I want to take an impulse entry, an ambush entry, an entry without waiting for a candle close, an instant entry, I should take an instant entry when a zone has been touched multiple times, because that zone is particularly weak because it has been touched multiple times. So now the price can just ram through that zone, and the chances of price doing that is much higher. So I don't need to wait for a candle close for such a zone if it's being broken, right? This is something that I learned when I was backtesting. Okay, so when I looked at the trades where I got a massive win, I noticed this. So the data itself is going to tell you so many things that you will automatically understand these things. And trust me guys, there's no secret to this, okay? I'm making this video, but actually there's no secret to this, because if you actually honestly backtest, you will notice certain things that you will feel like the charts are talking to you, the data is talking to you. So, and trust me, you will only understand this if you've actually done it, okay? But I'm making this video for you to understand how to actually interpret the backtested data, how to extract important information out of it, and how to make sure that you minimize your loss and make the system work, right? And now, when you do certain things, obviously you are going to realize certain things, right? So like, let's say you realize that what you should do is actually, you should just trade 2 hours in a particular day, or you should just trade on Monday and Tuesday. So now these are certain realizations that you will get. These are certain pointers that you will get, right? Then what you should also look at is the average risk to reward ratio that you're getting. Are you getting 2 or 3 or 4? Or what is the highest risk to reward ratio you're getting? In a month, how many trades are you getting? In a month, out of those trades, how many are wins? What percentage are the wins? So you will have a very good idea that, okay, after backtesting over 100 trades, I realized that in a month I get around 15 to 20 trades. So your mind is not going to expect more than that, because you know that after backtesting you get only 15 to 20 trades, right? So you won't feel like over trading. You won't feel the urge to trade. You won't feel the urge to trade unnecessarily, because you know that you get only 15 to 20 trades. And if you have got 15 to 20 trades, you will just sit on your hands, and that will make it so easy for you to just patiently wait for the trades to come, right? And when you know the timings, that will make so easy for you to just patiently wait for the trade to come, because you know after backtesting that this is the perfect time zone for me to trade. And that will just stop your bad habit of trading every single time and taking trades unnecessarily. Trust me guys, this is the best solution to actually just improve your trading psychology. Yes, we're going to talk about that, but truly this is the best solution. The problem with people is that they don't set the right expectations with themselves. Why they don't set the right expectations with themselves? Because they never backtest. Because they never backtest, they never even come to a conclusion that what they should expect from the market. And then they expect unrealistic things, and when they expect unrealistic things, they end up doing stupid things. When they end up doing stupid things, they end up losing their money, and then they are oblivious and they have absolutely no idea what the hell they're doing. So in the end, the main thing is to interpret certain things, right? Now, this is where I spoke to you about how to interpret data, how to actually understand data, how to extract data from whatever you've backtested. In the next lecture, I'm going to talk to you about how to, when you've interpreted certain data, when you have extracted certain data, how to actually make the changes in the system, how to actually start making changes in your system, and how to actually finalize Now, this is actually a not so important video, but still I have to make it because sometimes people do get extremely confused in terms of how to make changes in the system, and sometimes people overdo it and they're not able to reach to a conclusion, and they're just over confused at what the hell exactly they're doing with their system and their life. So let's talk about how to make changes in the particular system. So let's say you've backtested honestly, and after looking at the backtested data, you realize certain things. You realize the right timings for yourself, you realize the right days for yourself, you realize the right setups for yourself, because obviously when you backtest, you also look at the charts, you also look at the setups, and the setups also tell you that, you know, when there's a certain specific setup, it doesn't work out, and vice versa. When there's a certain specific setup, it always works out. Most of the time it works out. It's called an A+ setup, right? So you will know all of these things by the time you're done with backtesting, by the time you've done an interpretation of the entire data. And now is the time when you actually improvise. Now is the time when you actually start making changes in your system, right? So in the most simple language, what you have to do is basically discard what doesn't work and emphasize what actually works. And that's how basically you make money. So I'm going to give you a very interesting example. So I was reading this book. This book is called Sell Like Crazy. I read this book, I think 2 years ago. The author is Sabri Subi. So I was reading this book, and the author says that, you know, 96% of your revenue, no matter what business you are in, no matter what kind of industry you are in, 96% of your revenue comes from 4% of the activities that you do. I repeat, 96% of your revenue comes from the 4% of the activities that you do. So now if you are a founder and you have to maximize your revenue, what you should do is delegate 96% of the activities to someone else, to your employees. Focus on the 4% so that you can increase 96% of the revenue. Now the same thing, we are going to apply it over here. 96% of your profits are going to come from the 4% things. the 4% things, the small things are going to give you the massive profits. Right? So as a trader, what you have to do is emphasize these things, discard the unnecessary. So let's say you're getting trades on Thursday, okay? Now Thursday is a day where it's normally choppy. You're getting trades, but they're not very big winners. You're getting trades, they're going in your favor, but they're just turning back. They're going break even. Just discard it, okay? So the key to becoming extremely profitable and becoming profitable fast is to discard things that are not working and emphasize and exaggerate the things that are actually working. Right? So let's say you're getting your best trades on Tuesday and Wednesdays. Only trade Tuesdays and Wednesdays. Now, once again, I'm not asking you to forward test. I'm not asking you to trade with real money. What I'm trying to tell you is first make these changes in your system, okay? So let's say I'm going to trade only Tuesday and Wednesday. Let's say I've decided that I'm going to trade only from 11:30 a.m. Indian time to 1:30 p.m. Indian time, and I've decided certain technicalities about my system and all of that, and now I'm going to backtest this particular filtered version of my system. Okay, now this is where you will really unlock another level of trading. This is the enlightenment. This is the next level that you're going to unlock, where somehow everything is going to be working in your favor, because all this while for years everything has been going just against you. But now finally when you reach this level, and trust me, if you have actually reached this level, I am fucking proud of you, because 80% of the people who are going to watch this course are not even going to do this honest work. They're not going to do it. I just know it for a fact. They're just going to come here, buy this course, give some donation to me, and then just run away, because the worst part is people don't want to do hard work. But I'm talking to the 20% right here. If you have actually reached here and if you have actually done it, I'm fucking proud of you, man, or woman, whoever you are. So yeah, this is where things will actually start going in your favor, and you will start gaining confidence. You will start seeing that, oh shit, it's possible to make money from trading. Oh shit, man, it's actually freaking possible. All this while I was thinking, is it even possible or not? It's actually freaking possible. You're going to reach this phase, and then you're going to remember me. And trust me, it's going to be amazing. So when you finally reach this phase, what I want you to do is backtest this data now. And when you backtest this data, you will once again see the eureka moment and all of that. And trust me, guys, this is the last step towards becoming profitable. Not the last step, the second last step towards becoming profitable, because the last step is phase number 4. I'll see you there. Number 4, this is where we talk about psychology, but unfortunately a lot of people make psychology a very huge deal. I'm here to tell you the truth. The truth is that trading psychology is not such a big deal which people think it is, and by now you should be knowing that, because you, I'm assuming, has completed phase 1, phase 2 and phase 3, because if you have not, then this lecture is not going to make a lot of sense to you, and you will not be able to relate to what I'm going to tell you, right? And that's exactly why I asked you a million times throughout the course that don't ram through all the videos. Please watch the videos properly and do what I am telling you to do. And if you have done that, congratulations. I want to pat your back, but I can't because I'm on your screen. If I was with you there physically, I would do that, right? But if you have done that, then you should be having an agreement on this with me that psychology is actually not such a big issue, because most of the people, they don't have the technical knowledge which you've gained. Most of the people don't know how to build a system and how a system should be built, which you already know by now, and I hope you have built a system by now. And third, people don't backtest. People just watch a random freaking YouTube video from some guy sitting in his bedroom, which costs probably $100 a month, and copy that strategy, put it into the market, and guess what? It doesn't freaking work. So surprise, surprise, what did you expect? So they don't backtest, and I hope by now you know how to backtest. You have my cheat sheet. You have backtested your trading system. So now when you have these 3 things in check, the last thing that you have to check is yourself right here. But if you don't have these 3 things in check, you have no idea where the hell you're going wrong. And that is where most people are, especially people who haven't bought this course. That's where they are standing right now. They don't know where the hell they are going wrong, because they not do they have complete knowledge. They also don't know how to build a system. They also don't know how to backtest a freaking system. So it's a huge missing piece of the puzzle. And when you have so many missing pieces of a puzzle, you have no idea where the hell you're going wrong, right? But that's not the case for you. So let me tell you again, psychology is not such a big issue. But obviously, I'm not saying that it's going to be simple. And I want to now start talking about how to actually become a master of your own mind, how to become a master of trading psychology. Now, trading psychology is a term which I personally don't believe in. I personally believe that it's your overall psychology actually as a person which you have to master, because eventually how you think as a person is going to eventually reflect in your trading as well. All right, so I think trading psychology is a myth. It's actually just your psychology as a whole, as a person, which you are mastering and which you're trying to get a control over on, right? And I was reading a very interesting quote, and I think this quote was by somebody very, very famous who has done, I think, 100-200 million dollars in revenue for their company and built a multi-million dollar company for themselves. And the quote goes that the amount of money that you make is directly correlated to the amount of self-development you are doing, because how you are as a person will directly impact and will directly be correlated towards your income as well as your trading, right? And that applies in trading as well. So the number one thing that I want to tell you is, first of all, it's always going to be you versus you. And if you are not growing in trading, if you have all these three things in check and you are still not growing in trading, that basically means you are not working on yourself and you are not changing. You are not developing yourself. You're not improving yourself. So when you have these three things in check, you have to remember it's always going to be you versus you. Now, coming to the second thing that I want to tell you is, you should always have a description of what an ideal version of yourself looks like. So I want you to sit down. I want you to actually take this seriously and freaking do it, okay? Because I know most of you will just watch this on your phone and your computers, and then you'll be like, oh, whatever, this guy just says something or the other. I'm not a stupid guy, okay? I hope you know that by now. So I want you to sit down, take a pen and a paper, okay? Take a pen, take a paper, and write down what would the ideal version, what would be the perfect version of yourself would look like as a trader. So I want you to go like this, that Umar's ideal version as a trader, right? So I'm going to write like that, and I'm going to write that this particular version of myself is always disciplined, always follows the rules, always executes and enters trade as per the system, always manages risk, never over trades, never over leverages, never over risks, whatever you want to write. Because you know whatever the hell you've been doing in the markets. You know what mistakes you make, you know where you go wrong. And obviously your ideal version, your best version of yourself as a trader is not going to make those mistakes. So I want you to describe your ideal version as a trader, and maybe stick it up somewhere. Maybe stick it up wherever you constantly look at it, or look at that all day, because that's going to subconsciously program your mind as well. That's a whole different story altogether. But do that. And then I want you always to keep yourself in check. Okay, so whenever you're trading, whenever you take a particular trade, I want you to always look at that particular note that you've written down and always compare it with the particular trade that you took. Now ask yourself that, okay, this is a particular trade that I took. Now, would my ideal version, would my best self as a trader perform the same as I did? And if not, then what would be different? What would I change about myself? What would be different? And you will slowly start to get the answer. You will start to get those answers, that what exactly you need to work on. You will start to get the mistakes you've been doing constantly. I want to do this practice with every single trade, with every single time and every single emotion that you feel as a person, right? I don't want you to just think about the end product. I don't want to just think about the end of the trade, right? If it's a profit or it's a loss, doesn't freaking matter. I don't want you to think about whether it was a profit or a loss. I want you to intensely think about that particular trade, right? So let's say I enter a particular trade, price goes in my favor, then goes a little against me, then goes in my favor. So it's a roller coaster of emotions that I'm going to feel, right, as a person. So when it goes in my favor, I feel like I'm the fucking god. I am the god of trading. I know how to make $1 million. I'm the best in the freaking world. But when it pulls back, I feel like a little kitten who's scared because, oh no, now I'm not the god anymore. I'm going to lose money. Oh no, another funded account. I'm going to blow it off. What the hell? But then again, when the trade went again in my favor, I again feel like I am the enlightened person on this planet and I'm the best and I'm going to come on the #1 leaderboard of funding pips and FTMO and whatever the hell you're trading. So it's a roller coaster of emotions, right? So I want you to intensely ask yourself that, okay, so I felt primarily 3 major emotions throughout this particular trade. Now, how would my ideal self act during this entire trade? So my ideal self during this would probably be very, very calm, very, very stationed, very, very composed, Okay, so trade is going in my favor. Perfect. That's what's supposed to happen because I am trading a proven strategy, trading proven system, trading a backtested system. So obviously, if I am taking a trade, I'm not a freaking fool. I am doing what I'm supposed to do, and the market is doing what it's supposed to do. So I will be calm and composed. If the price is pulling back against me, that's absolutely normal because pullbacks do happen. You know, there's no light without dark. There is no downtrend without lower highs, right? And there's no uptrend without higher lows, right? I said it in verse. Anyway, you get my point, right? So you need to intensely think about yourself and constantly review yourself. Keep yourself in check and compare. Always compare yourself with your own ideal version as a trader, right? And this exercise is going to massively help you out. And eventually you're going to realize that it is all about discipline because you, after finishing this course, you are already going to be better than 90% of the crowd because 90% of the people don't even know all of this. They don't even do all of this, right? But eventually you're going to realize that, and I hope so, that maybe in the next 2-3 months you will see signs of profitability, right? You will see that you are able to clear funded challenge. You will see that you're able to maybe get your first payout. I really hope so you do. Maybe get your first few payouts. But that is when you will realize that when you maybe experience a certain drawdown, or maybe when you get your first payout, maybe when you make certain amount of returns on your account and you place that withdrawal from your broker, you elevate or de-escalate from the ideal version of yourself, right? So when you get a payout, you go here. And it's very important to keep yourself in check and bring yourself back down here because this is where you make mistakes and blow accounts. And then when you come here, when you, let's say you are in drawdown, again, it's very important to bring yourself back up here because again, this is also where you take unnecessary trades, unreasonable trades because you tell yourself, fuck it, man, I don't care because I've already blown 5%. It doesn't really matter. So it's very important that you bring yourself back up over here. So you always keep yourself in check and eventually you're going to realize that it's all about discipline. And whenever you are facing these ups and downs, it's about being disciplined during these ups and downs and doing what you're supposed to do. And that is what is going to make you consistently profitable. Because whatever I've told you by now will make you profitable. But what will make you consistently profitable is doing this and keeping yourself in check again and again. And guys, it's always and always going to be a constant self-improvement. Whenever you're journaling, whenever you're backtesting, whenever you are looking at your system, whenever you're taking trades, always and always be your biggest critique and your biggest fan. And I think this applies to everywhere in life, and I follow this very, very strongly myself. I am my biggest critique and I'm my biggest fan. I do so much positive talk that sometimes people feel that I'm a narcissist, and I don't care. Because if I'm not going to praise myself, who the hell is going to praise me, right? And if I can't even praise myself, then how can I expect anyone else to praise me? Right? And the second part, which is being your biggest critique. I'm my own biggest critique. I self-reflect so much that I am so harsh on myself, you can't even imagine, right? So always be your biggest critic and always be your biggest fan, because this is going to help you unlock dimensions and different things and explore so much about yourself. And that is when you will know what to focus on, what to work on, and how to be the best version of yourself, right? So when you take a particular trade, let's say you lose, be your biggest critic and be your biggest fan. Okay, you lost, but okay, there might be some good things that you did. Maybe you risked only 2%. Maybe you followed your rule. Perfect. Claps for that. But the entire trade could have been avoided in the first place because you did not follow your rules. This was not a proper setup as per your system. So that's where you have to work on, right? But also be your biggest fan, because if you would not have followed 2% rule, you could have blown your freaking account in this particular trade, which was not even necessary. All right. So always look at the good and the bad and be extremely honest to yourself. And that is going to be very, very important for you to grow and be better constantly as a trader. And last but not the least, you need to know that self-mastery has no end. As a trader, as a person, we are all here to master ourselves. We are all here to be better than we were yesterday. Always compare yourself to how you were yesterday to how you were 3 months back. And if you're doing better financially, health-wise, mentally, relationships-wise, you're doing good. And you got to keep getting better and better and better and better, right? So this is all you need in order to become profitable. And keep journaling, keep critiquing yourself, keep criticizing yourself, and always keep praising yourself, because I feel that is where a lot of times people miss out on. And it's very important that you keep doing all these things. And most importantly, always make sure you journal. Always and always make sure that you are being aware, because if you're not even aware of what emotions you're feeling and what thoughts you're going through, you won't be able to critique that, you won't be able to praise that, right? So always be journaling, always be extremely self-aware, And last but not the least, I just want you to know that you have successfully completed this particular course, and maybe you will need to watch the psychology masterclass again and again. And if you do, it's absolutely normal. And maybe you should, if you've finished watching the entire course, you should in fact watch this course at least 2 or 3 times more and more and more, because every single time you watch this, you're going to learn something new, you're going to pick something new. And that's how I like to learn as well. And most importantly, I am really happy to make this course, and I'm really happy that I am finished shooting this, and this is the last lecture of this entire course, because I have really put in my heart and soul into this, and this is my personal blueprint of becoming a profitable trader. And I can once again assure you that this course is going to produce a lot of profitable traders throughout the world. And I just hope that you watching there in some part of the world, and maybe in India somewhere, you also end up becoming one of those people who become profitable because of this course. And I'm very positive about it, and I'm really happy that I was able to put this out there, provide this value to you. And last but not the least, again, one more thing, make sure you're part of our Discord community. If it is still available, whenever you're watching this course, if it is still open, if it is still available for you to access, make sure you become part of that network, because that network will also keep you always in check. When you're around such people, when you're around traders, when you're around your mentor, and you're already every single day looking at what is right and what is wrong, that has its own value. Because yes, this course will help you, but experience has its own value. And for you to maximize that, you need to be among people who are doing better than you in the particular thing that you want to be better at, right? So make sure you're part of the Discord community if you're not. And the only last thing that I want to say before I finish this off is, I'm really rooting for you, and I hope that you all make it. And I truly hope from the bottom of my heart that you all make it in life, you all become successful, you all become profitable traders. And I hope